The number on the balance sheet read $1.5 billion. It was a lie. For years, Satyam Computer Services stood as a shining example of India's burgeoning tech industry. A global IT powerhouse, trusted by Fortune 500 companies, a symbol of national pride. Its founder, B. Ramalinga Raju, was a revered figure, a visionary. But behind the facade of success, a different story was unfolding. This wasn't merely a case of creative accounting. It was a fabrication on an epic scale. A deliberate, systematic deception that ballooned over years, designed to inflate earnings, deceive investors, and mask a gaping hole in the company's finances. The eventual collapse would send shockwaves far beyond India's borders. The seeds of this deceit were sown in the late 1990s and early 2000s, a period of unprecedented growth for the Indian IT sector. Satyam, meaning truth in Sanskrit, was perfectly positioned. It offered IT services, software development, and consulting to clients across the globe, generating impressive revenue figures. B. Ramalinga Raju, the chairman and CEO, was a charismatic leader. He built Satyam from a small startup in Hyderabad into a global enterprise employing tens of thousands. His public image was impeccable, a philanthropist, a business titan, a man of integrity. This perception made the eventual revelation all the more shocking. The scheme began subtly. Raju later confessed that it started with small, manageable distortions in the balance sheets to cover a poor performance. But once started, it was a treadmill he couldn't step off. To maintain investor confidence and stock prices, the lies had to grow larger, more intricate. One of the primary methods was the creation of fictitious invoices. Satyam would bill clients for projects that never existed or inflate the value of real projects. These fabricated revenues would then be recorded in the company's books, painting a picture of robust financial health. The corresponding cash, however, wasn't materializing. To reconcile the fictional revenue with the non-existent cash, Raju and his accomplices created thousands of fake bank accounts. They would then show these accounts as holding the company's cash reserves, a monumental feat of digital forgery. The scale was staggering. By the time the fraud unraveled, over $1 billion in fictitious cash and bank balances had been reported. This wasn't merely a few million here or there. It was a substantial portion of Satyam's reported assets, a house of cards built on pure fiction. The auditor, Price Waterhouse, a part of the global PwC network, was supposed to be the safeguard. They signed off on Satyam's financials year after year, giving them a clean bill of health. How could such a massive fraud go undetected by one of the world's leading auditing firms? This question would haunt the aftermath. Investigators later found that the auditors either missed glaring red flags or were complicit through negligence. The fake bank statements, for instance, were never independently verified with the banks themselves. A fundamental auditing principle ignored. The first cracks began to appear in December 2008. Raju attempted a desperate maneuver. He proposed that Satyam acquire two companies owned by his family members, Mehta's Properties and Mehta's Infra, for a whopping $1.6 billion. The market reaction was immediate and hostile. Investors saw through it. The acquisition made no strategic sense for Satyam and was clearly an attempt to funnel money from the public company into Raju's private ventures, likely to cover the growing financial hole. Share prices plummeted, and institutional investors openly rebelled. Facing immense pressure and with the truth about to burst, Raju made a fateful decision. On January 7, 2009, he confessed. In a letter to Satyam's board, he admitted to a multi-year accounting fraud, stating he had been riding a tiger and didn't know how to get off without being eaten. His confession was chilling. He admitted that the balance sheet had inflated profits and the cash and bank balances were largely non-existent. The true operating margin was a mere fraction of what had been reported. The numbers were off by over $1 billion. The aftermath was immediate chaos. Satyam's stock price collapsed, wiping out billions in shareholder wealth. Employees faced uncertainty, clients panicked, and the reputation of India's entire IT sector was tarnished. It became known as India's Enron. Regulators, both in India and the United States, launched investigations. Raju, his brother, and the former CFO were arrested. The auditors from Price Waterhouse also faced severe scrutiny, leading to bans and heavy fines. The Indian government moved swiftly to contain the damage. They dissolved Satyam's existing board and appointed a new one, tasked with finding a buyer and restoring investor confidence. This intervention was critical in preventing a complete meltdown. In April 2009, Tech Mahindra, an Indian IT services company, successfully bid for Satyam, acquiring it and eventually merging it into its own operations. This acquisition provided a lifeline, saving thousands of jobs and preserving client relationships, though at a significant cost. The legal battles dragged on for years. In 2015, Ramalinga Raju and his brother were sentenced to 7 years in prison and fined for their role in the fraud. Other executives and the auditors also faced convictions, though their sentences varied. The Satyam scandal served as a stark reminder of the dangers of corporate greed and the critical importance of robust governance and independent auditing. It exposed vulnerabilities in India's regulatory framework and prompted significant reforms. It demonstrated that even seemingly untouchable corporate giants could be built on a foundation of lies. The pursuit of ever-increasing profits, unchecked by ethical boundaries, can lead to catastrophic consequences, not just for shareholders, but for an entire industry and nation. The lessons of Satyam resonate today. Investors remain wary, regulators more vigilant. The scandal underscored that trust, once broken, is incredibly difficult to rebuild, and the repercussions of corporate deceit can ripple for decades. To understand another colossal failure driven by ambition, watch our deep dive into the collapse of long-term capital management.